Ah! Guys, I just spent a half hour recording this video and I realized that I had my microphone muted. This always freaking happens. Jesus Christ, but we're going to give it a second shot. What is up, everybody? Welcome to Trace Trades. We get technical analysis of different stocks in the stock market, as well as potential buy, hold, or sell opinions on these given stocks. I can preface by saying that I'm not a financial advisor nor an expert, so take it or say it with a grain of salt. Let's get into the video. Today, my friends, we're giving you a basic overview on what the heck is going on with AMC. A basically fundamental overview and a round overview in case you are new to the channel, right? Then you're new to the AMC situation, because I know there are a lot of people out there who have never looked into this until maybe yesterday, 5 days ago, a week ago, 2 weeks ago, a month ago. Regardless, you're probably sitting there like, what the F is going on? And we're going to get you caught up. So we're going to give you a basic overview, right? This is just a touch point. It's basically a round look at what's going on. And I wanted to draw up something for you. I've got freaking Kong right here, drawing up in some good detail. Had to give you a little bit of a celebration note. Yes, Kong will win the battle. But here we go, right? AMC round overview. Let's get into the stock. Let's get into the video. So AMC Fundamentals. We're going to start off here. What is the upside with the company? Why should you care? Where is the actual logic and reasoning behind why this is a stock that everybody's talking about? First thing, recovery from COVID, right? So this is no secret to anybody. COVID and quarantine across the world in the United States has been detrimental to the market, to a bunch of businesses, large businesses and small businesses, AMC being no exception to that. Now, if you think about it, the revenue, which we'll show you here really quick, you can see this in pretty plain English, ape language, that they've been hurt. They got crushed by it. Looking at their annual revenue, 2020, they saw $1.24 billion in revenue, gross profit of about $830 million. Compared to 2019, that's about 1/3 of their total revenue that they saw, almost 1/4, honestly. So it got crushed and it was tough. So you can play it off as a recovery play there, and they have already begun the process. In fact, theaters are opening back up at a 98% capacity on the 19th, which is tomorrow. All right, so check this out. It's Showtime. AMC Theaters says it will have 98% of its U.S. movie theaters open on Friday, as a bunch of theaters reopen in California. Even more theaters are expected to open by March 26th. They are debuting Kong versus God freaking Zilla, baby. What a beautiful, I would say, analytical, analogical representation of the fight that's going on right now with AMC, right? And we don't expect them to be a cash cow. I'm going to provide you the bear side of this, right? Where's the downside? Well, we know and we understand that AMC is not going to be a fundamentally and cash cow strong company within 6 months. They're not going to be hitting new all-time highs within 6 months because they're not going to be at full capacity. We understand that, right? That's not why you're getting to the stock. And if the stock market works solely only on fundamentals and crunching numbers, right, then there probably wouldn't be much upside here. But unfortunately for the old school investors, the old time brokers from the 70s and 80s, whoever they might be, right, there's more that plays into a stock than that. It is trader sentiment. There is short interest. There's gamma squeezes. There's short squeezes. There's so many. There's honestly memes now. I mean, you've got three different categories of investors. You've got bulls, you've got bears, and you've got apes. And apes are stepping into the stock right now with this situation. So that's what you're looking at, the pros and the cons of the recovery from COVID. But I am bullish on it, and I do think in the 6 month to 12 month range, this would be a great company to invest in, regardless of a short squeeze or gamma squeeze situation. So that's one thing to talk about. Second thing, we're addressing the market situation, their cash. What are they sitting on? So they've raised money to manage their operations, and that is something worth talking about and bringing up. So this company was on the verge of bankruptcy. Adam Aron, who's the CEO, has publicly stated many times, guys, we're in a world of hurt. And until they raise some cash, which I will show you guys really quick, back in January 25th, they raised $917 million of capital to take bankruptcy off the table to be able to continue operations as of the end of 2021, which is massive. That gives them some financial runway. It allows them to play the game a little bit, to diverse and find some strategic overview capabilities to continue their operations and rebrand, maybe find a way to continue to grow as a company. This is a 100+ year old company, guys. They are an economic powerhouse, a market powerhouse, and everybody remembers them just for nostalgic value. I can think about the same thing with GameStop. I mean, you think about GameStop, I spent hours of my life there. It was like a kid in a candy store, man. I just could not get enough. Every opportunity that I had, I remember telling my dad, I'd say, hey, man, I tell you what, let's stop at GameStop after we get done doing whatever we're doing at the grocery store or Walmart, right? And let's just look at the games. I wouldn't even buy anything. I would just look. Same thing can be said about AMC Theaters. I've had some great memories and great moments with my dad, with my old man, who's no longer with me, unfortunately. And there's like the nostalgia factor there is insane. And the bear side of this, right? People argue, well, what happens if nobody goes back? They say, okay, we've got streaming services now, if we just wait 3 or 4 months to go to see the movie that you're streaming in the theaters, you're playing in the theaters, I'd rather do that. And my counter to that is that's just not true. At least in the short term, the midterm, right, the 6 month to 12 month range, you're gonna have people that have been cooped up in their house for literally a year plus who are like, you know what, man, I'm excited to actually go out and do something, and watching a movie, watching Kong versus freaking Godzilla, baby, is an opportunity to do that. So take that for what it is. I think that is a huge, huge opportunity there. 3 different scenarios. One, you've got a squeeze, which has infinite upside. You can have an endless feedback loop of buying, gamma squeeze, short squeeze, that can drive the price up to $1,000 and $2,000. It sounds insane, but I really do truly think that you could have AMC hit quadruple digits and GameStop hit quintuple digits. And I'm not playing when I say that. And we'll get into the details more. Second scenario is an acquisition, an AMC or Amazon acquisition, and you make money per $1 billion in acquisition. So hypothetically speaking, let's say that they're going to offer you $10 per share per $1 billion in acquisition. The company is bought out for $10 billion. You receive $100 a share, which is an insane upside. And it all comes down to how many shares you own. At that point, the price is psychological. And there's actual, I would argue, science pointing to the fact that that might actually happen. So I've seen people argue about the 500 million share dilution that may possibly happen in May. They're voting on this in May. Hey, should we, put 500 million extra shares into the market? And people are like, oh no, if they do this, that is going to crash the stock. It is going to destroy the company. Please, please, please don't let this happen. But this is an opportunity for other companies such as Amazon or Netflix to step into the game and take a stake in the company. So in order for some companies to be able to have shareholder or voting rights in a company, the board of directors, yada, 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 they have to own X amount of the stock. And this is an opportunity for them to do that. If they own 500 million shares of the stock, 500 million is more than 400 million. That gives them a major stake in the company so they can have voting rights and decision over what happens with the company fundamentals. That would allow them to rebrand. Guys, you can see the upside here with an acquisition play. Whether it be Amazon, whether it be Netflix, both of these companies would be able to rebrand, whether it's streaming services, right? Netflix is a dominant powerhouse of the stock of the market in terms of streaming. That would be monumental. I mean, they'd be able to play movies. Maybe they air in theaters, and 3 or 4 days later, or a week later, they play them on Netflix. That's an opportunity that no other streaming service is going to have, which would just give them a further edge as the leading market monster in streaming services. Amazon would give them an opportunity to step into the game and be competitive, right? Because nobody really uses Amazon streaming services. That's not what they're known for. However, Amazon is a cash cow, and they would not be playing this. They would not even be looking at them if there wasn't an opportunity for them to make money here and to rebrand AMC into something they see as a huge opportunity. So take that for what it is. I think both of these scenarios are very likely. And there's one thing that I want to point out to you that I think is worth talking about, and it's Amazon's largest institutional investors. Now check this out. On the 12th and the 13th, pay attention to the dates. The Manufacturers Life Insurance Company and 4 other companies, Nomura, American, Public, and Stifel, all bought into the company on the 12th and 13th of February. Those same companies bought into AMC on the 13th and 12th. American, Nomura, Public, the manufacturers, as well as Stifel. That may be a coincidence, but I don't think there's coincidence in life, right? I think that's worth noting because that would not be by accident. So that we've got multiple big institutional investors stepping into both AMC and Amazon. Typically, they have insider information. They know a lot more what's going on in terms of the backdoor side of things with both companies. And that tells me that there is an opportunity for that to be a legitimate thing. So you've got that opportunity for them to take a major stake in the company, which I think would make sense if you think about the 500 million share dilution, whether it's Amazon or Netflix or whatever company it may be. An acquisition is 100% possible. Then the worst case scenario is a recovery play. Conservatively, I think it's going to be $20 in the next 4 to 6 months. And liberally, I would think it's going to be $25 in the next 4 to 6 months. And that is because they're going to start generating revenue. You're going to see this reflect on their earnings reports, whether it be Q1, 2, 3, 4, right? They're opening theaters again, which is allowing them to generate revenue. And one thing that's good to point out in regards to the revenue is this. If you look at their annual revenue, how much are they pulling in? $1.24 billion. Comparatively, they keep $830 million of that in gross profit. That is great margins. They're only paying $411 million out of their cost of revenue. That's huge. That's huge. 2019, 2018, 2017, they keep a lot of their profits. In fact, they've actually been improving their margins year over year over year over year. And even though 2020, they weren't doing well, the total revenue was terrible. It got whacked down to about a quarter of their usual revenue. They put $1.07 billion, which is just barely lower. In fact, it was higher than 2018 and 2017 into marketing and administrative expenses. So they're doing everything they can to assure people, hey, we're going to be back. We're going to do everything we can to be the same powerhouse and the same nostalgic market leader in theaters that we have always been. And that shows and reflects in the income statements right there in front of your very freaking eyes. So take that into consideration. That is 100% something worth noting. Now, the next thing, you can see that I've drawn on this as I did come to it previously, is the shorts, the institutional buyers, and the insider buyers. So what's going on with shorts? What is worth noting? So you've got ETFs, you've got stock, and you've got puts. These are three ways that hedge funds or institutional investors have been manipulating the stock and schwacking it down. We're gonna start off here with ETFs. So I've got this pulled up. This is I've got a link down there. It's a 2K bull case for AMC. This is a list of all of the ETFs that have, short positions in AMC or GameStop, both of them, right? SFYF, you got VBR, IWN, SCHA, IWM, VTWV. All of these different ETFs that hold both AMC and GameStop have short positions in those companies, right? That's huge. They're basically is saying that there's huge short interest in AMC through those ETFs. On the same side of things, if you were to look at just the AMC short positions, you have this huge list right here, which is also available in that freaking Reddit DD, and there's links, hyperlinks to every single one of these. So all these different ETFs that have short positions in AMC tells you the entire freaking game. If you look at the available shorts to borrow, right, they're usually pretty freaking low, meaning that these are being shorted heavily, and it's a backdoor way for hedge funds to manipulate the stock and short the stock, trying to make this thing drive freaking down. Insane. So that's one thing to pay attention to heavily, and it's usually pretty backdoorish. You don't see a lot of talk about it because it's not as available to the public. This is hedge funds trying to basically hide the fact that they're trying to destroy the stock. And people have caught on to it, and Reddit is an opportunity, Discord is an opportunity, YouTube is an opportunity to talk about it. And that's what I'm doing right now. You've also got puts. Puts are a type of option play. If you're not familiar with puts, we'll walk you through the basic rundown of these right now. Options right here, if you come over to puts is basically betting on a stock going down. So if you were to look at, let's just say we'll use RKT as an example, right? If you were to look at the call options, this is basically betting that a stock is going to go above 1689 if that's the price that you hit that at. So that's a strike price of 1689. I'm going to say, hey, by the 19th, which is the date up here, I think that rocket is going to close above 1689. If it goes above that, you make money. On the flip side, you've got puts. And if you were to play it this way, you'd say, hey, I think that by the 19th of March, the price is going to be low, the market value is going to be below my strike price of 2289. And if it's below that, you make money. This is a backdoor way for hedge funds to short a stock because they don't have to report their short interest here. These are numbers that they have to allocate specifically on their filings, right? Which is massive. So these are two backdoor ways that they can short a stock. And if you look at AMC specifically, right? Hopefully this freaking loads finally, and it did. Look at the puts here on the 19th alone. There are 17,900 puts at that 0.5 strike. Do you think there are any retail investors in the world that will look at this and say, yep, I think it's going to be below $0.50 on the 19th of March, 2021? Absolutely not. That doesn't make any sense in the least bit. These are hedge funds. These are toots. These are the bad whales. These are the killer whales. These are not the cute killer whales. They're the bad killer whales, the ugly killer whales, the ones that actually eat puppies and cats and stuff. And we do not like these guys. These are bad whales. So that's what's happening right here. That's a backdoor way from the shortest stock. It doesn't make sense. So these are two kind of slight-handed ways in which they are hiding the fact that they want this company to go bankrupt and they're trying to kill it. Stock is another example, and this is much more open to the public. Today alone, there was 36% of the total market volume as short volume. And I've covered this before. I'll show you a basic overview of what this means. So just let me pull this up really quick. I have this bookmarked, and I'm going to show you an example. So the daily short sale volume, I've calculated the numbers already, came out to 36%, but there's 30.1 million total short volume of shares out of the total market volume of what would have been today. Let's just do some quick number crunching. Make sure that lines up right. This was the 18th. Yep. So if you do some quick number crunching, 30 out of the total market volume comes out to, just do some math here. Total market volume today was 122 million. So that comes out to the majority of the market volume being short volume. So that's massive. That tells you the entire freaking percentage right there. 37% of the total market volume right there. Boom. Right in front of your eyes. It's been as high as 59%. 59% again. We have 58%, right? So it's a crazy shorting that's going on here. So it's still live balling. You can see this happening before your eyes. I also have Vortex pulled up, and this tells you the exact numbers. 84% utilization as of today, which tells you that out of the total lendable shares, 84% of them are being held, and that means only 16% of the current shortable lendable shares are available for borrowing. That means it's very heavily shorted. Cost to borrow not very high. That is an annual interest rate that is accrued, 2.49. So not a lot of pressure right now. It has been higher, but I anticipate it'll go back up. Those are the two things that I think are worth paying attention to right now in regards to the short interest on AMC. So take that for what it is. Institutional buying. There is continued institutional buying that keeps stepping into the game here, which is 100% worth talking about, right? So we're going to start off with that. If we come over here to the institutional buyers, look at this. Major shareholders from Vanguard, BlackRock, Mudrick, Middleman, Greenville, Janus, Luxor. I mean, yesterday alone, you had Fidelity step in with 5 of their different management programs, specifically the largest being their small cap index fund, bought 500,000 shares at a dollar cost average. I crunched the numbers of $12.36, or $13.26 as I was. So massive. I mean, that tells you exactly what's happening. The only way they could have purchased that at $13.26 is if they bought it yesterday or the day before. So that tells you that there's some big wigs out there who think this is going to be bullish, right? You got to look at a holistic picture. And I'm showing you every single aspect of what's going on here with AMC. And that's a big one. Huge toot buying coming into the game, right? Playing the stock, trying to get this thing to move. And these guys don't try to make money if there's not an opportunity to do so. And I talked about this a while ago. I said, guys, you've got some short positions from hedge funds out there who are trying to drown the stock. And you're going to have some smart people. And you can go back and look. I said this a month ago. I really do mean it. You're going to have some smart hedge funds out there that say, you know what? There's no way this is going to go down to $0.50. There's no way this is going to go bankrupt anymore. Now with the attention on this, we're going to go freaking long. And it's not because they're trying to help us. They're not trying to help the little guy. It's cutthroat business, baby. They're trying to bankrupt these other hedge funds because they want money. It's a competition. They don't care about drowning out the other 1% because they want to be the best of the 1%. And that's why they're in the game. And they're friendly toots, though. They're friendly whales. They're trying to help us out. But this is a way they're trying to do it, is stepping into the game and going long and killing these other short positions such as Melvin or Citadel, who are playing the wrong side of the coin, man. They're going against the flow of the river. And that is institutional buyers going long on that. So it's continuous buying. You've got huge stakes in here. You've got the Amazon stakes. You've got Fidelity, Vanguard, BlackRock. I mean, Vanguard and BlackRock alone should tell you everything you need to know because those guys are infamous for being the best of the best. And then you've got insiders confirmed buying, which is massive, right? So if we look at this alone, what do we have pulled up here? I'm going to find this. You've got Adam Aaron, Shavaria Carla, Sean Goodman, Frank Elizabeth, Colinero Steven, and Connor Kevin. All of these guys have really heavy stakes in stock. And if you look at this amount or number of shares, 949,000. And then up here, the title and amount of securities underlying derivative security. So this could be a combination of both options and actual physical tangible shares. Derivatives referring to options. They don't have to actually have the collateral for those because they are contracts. So we don't know the date in which these guys expire, but what we do know is that there are shares that are being issued to board of directors members, and that is a big deal. This could be two things. It could be actual physical buying. This could be insiders that are buying actual physical stock, or this could be some sort of rewards program for the board of directors, meaning that the company itself is issuing the stock and the options to those who are interested in it, and these guys would not accept that, or they wouldn't issue the stock if it wasn't worth doing. Because think about this from your perspective, right? If you were a board of director for a failing company, would you want their stock? Would you really want their stock? Because you'd be thinking, why would I want your stock? It's going to be worthless in 5 years if you guys go bankrupt, right? So that's massive. That tells you that there are good things happening on the inside. At the very least, it tells you that they believe the stock in the company is going to recover. And that's big. And they wouldn't do it if they didn't think it was in their best interest because it would only hurt the cause. It would not help the cause. So that's massive. And that is definitely worth pointing out as well. Guys, if you want a quick water break, feel free to do so. I'm not going to take one. I'm going to keep chugging along, but this is going to be a pretty long video. I think we're about halfway through. So, hedgy manipulation. We've got a couple different things here that are taking place. We've got failure to delivers, and this is probably one of the first things that I think is worth touching on. So, what is an FTD? We've got this drawn out. Right, so essentially what you have is, let's say that you've got a clearinghouse who is spotting, they're basically, a hedge fund, we're going to say hedgy and tendy. So hedgy says, I'm going to short 100,000 shares into the market, and he ends up borrowing them, right? He borrows them from a broker. So a broker over here spots him 100,000 shares, and he doesn't actually have the shares right now, so he gives out IOUs instead. So that's an IOU, goes out to the clearinghouse, this IOU is worth 100,000 shares, 100,000 shares gets sent into the market, boom, tendy over here picks them up, has no idea they're IOUs, and he's just holding on to them, and we'll say hedgy over here is just straight chilling. What happens is they keep sending these out. These IOUs keep sending them out, and they don't end up matching them with actual collateral shares. The original intent of IOUs and FTDs was not malicious in the least bit. It was actually meant to say, okay, so I know in 2 days I'm going to get 100,000 shares back. So I'm going to spot 100,000 shares right now, knowing that in 2 days I'm going to get my 100,000 shares back, and I can give them out to this guy in which I sent out the IOUs to. I'll pay back the IOUs. Well, now what's happening is these FTDs, these failure to delivers, they're sending out IOUs maliciously and on purpose, knowing that they're not going to be able to get those back. They're saying, all right, screw it. We're just going to mess up the supply and demand chain and send out these IOUs over and over and over, which gets sent into the market, which dilutes the overall share count. Right now, we know that there is somewhere between 400 to 450 million total shares circulating in the market legally, right? Now, let's say that you have 200 million IOUs that are written up that haven't been accounted for yet and have not been replaced. Well, that causes synthetic selling pressure. Now, what do I mean by that? Look at the supply and demand chain right here. Now, this is supply and demand. High, low, low, high. So if you shift the supply up, you increase the supply, what happens is you have a lower divergence on that demand chain. It lowers the demand of a stock. That's basic economic supply and demand. Right? So by sending out these synthetic shares, these failure to delivers, you're manipulating the market. You're creating a synthetic selling pressure that shouldn't exist because there's a higher supply overall than should actually presently exist. So that's freaking massive, guys. Next, you've got ETFs, naked shorts, short laddering, collusion, and then supply and demand. We covered the supply and demand. We covered the FTDs. Next, we're going to talk about the ETFs a little more briefly, right? This is a backdoor way for the manipulation to take place. They're going through some backdoor methods, shorting ETFs that people don't really talk about in order to drive the stock price down. Nobody would really think about that, right? But there are a crap ton of ETFs out there that hold AMC, as we mentioned before. We're going to only touch on that briefly because I did touch on it. If you want to check that out, there is DD in the description box down below. Naked shorts, right? Now, what is this? This ties into the failure to delivers, but I'm going to give you a basic overview. Naked shorting is a legal practice of short selling shares that have not been affirmatively determined to exist. They're synthetic shares. They're not actual tangible shares. This can be very malicious and is illegal. It's not supposed to happen. Now, if it's not malicious, right, so let's say that you have a clearinghouse or a broker that sends out 100 million shares to a hedge fund sells them short into the market, and they're supposed to be replaced later, that's okay, right? There's loopholes allowed to happen. But when they're not replaced, that naked shorting is not good. They can't do that, and that's big. So that's another way that this is being manipulated, and hedge funds and clearinghouses have to collude to be able to know this, which comes into that collusion, which I have labeled down here. There are multiple entities that are allowing this to happen, whether it be the SEC, I don't know if they're necessarily doing that, but what I will say is they're involved. You've got hedge funds, you've got clearinghouses, you've got brokers, you've got brokerage firms, Robinhood being one of them, which we'll get into here in a minute, right? But there's so many different ways that this could be playing out for a negative downside turn, right? If this is true, this is like a 2008 house marketing crash sort of situation where, oh my God, when this gets brought to the limelight and everybody gets taken down, it's going to be jaw-dropping. You're going to be absolutely blown away. And this is happening in front of our eyes. Guys, I truly do think that this is another crazy situation where you've got insane illegalities taking place, and I want to be on the right side of the coin here. Short laddering, what is this? I've got this drawn up really quick, so there's a limited downside, a limited upside profit potential. Maximum gain is limited to the initial credit received if the stock drops down. So essentially what's happening here is I have a video talking about this on the channel, but you've got incremental sell walls that pop up a couple cents below. It could be between a 5 to 7 cent spread. Let me pull up the picture really quick. So you've got incremental sell walls that pop up on a stock, and its initial intent is to drive down price action. So check this out. This is a short ladder to a T. Look at this, 2,000, 3,000, 2,000, 3,000, 3,000, 2,000, 2,000, right? The same size being taken up in incremental spreads across the ask. This is shorting, and this is an attempt to not allow the price to draw itself up. That is short laddering, and that is collusion on, maybe it could be one hedge fund, two hedge funds, three hedge funds, who knows, but it's algorithmic system making that drives the stock price down to freaking the shadow realm, to kingdom come, as low as they want to drop it, because the buyers have to match 3,000 shares on top of their buy in order to get the stock price to move. Because shorters don't have to meet a buyer. They can just, as soon as the stock price hits that number, boom, sell into the market, and it can tank the stock. They don't have to meet a buyer unless it's on the bid because of that short sale rule. So that's massive. That's another piece of the manipulation tactics that are taking place right now. Short laddering, naked shorts, collusion. And then the last thing I want to talk about is Robinhood. Now, Robinhood, or Robbing Hood, as people have called it, is massive. And this is a big deal because Robinhood has been accused now of basically not holding actual tangible shares that they have been spotting their investors. And that is some crazy, crazy manipulation. We know that they've had ties and reasons to collude with companies such as Citadel or Melvin because they have investor relations with both of these institutional companies. And that's massive because that is just adding to the hedging manipulation that is taking place here with Robinhood. If you want to check that out, that is definitely worth talking about, my friends. Where is that? I'll show you this right here. If you've read the huge Robinhood never owned your GME shares, please just read this and calm down. You will not be held accountable for that. That's definitely worth talking about. I know that that's a scary thing, but check this out. You held up on your end of the deal. So if we're going to check this right now, you've got a buyer and you've got a seller. Buyer is obligated to spot money for their shares that they're purchasing. That's your obligation, your end of the deal. And the seller is obligated to give you physical shares. Now, if you gave them money, right, you did that, you're good to go. But if they send you synthetic shares, they didn't actually hold up their end of the deal. They sent you IOUs. They never ended up sending you shares. Well, you held up your end of the deal. You're good. These guys that sent you IOUs, they're not. They're screwed. They're going to get dicked down on that. Oh, man. They're going to get screwed on that. It's not going to be it's not going to be good, right? So you'll be fine. You'll get your end of the deal held up. And if you don't, that's a lawsuit that you will 100% win. So, that's a lot of stuff. I want to walk you through all the manipulation tactics that are taking place. And the last thing right here is this, the gamma and short squeeze potential and why we can end up making a crap ton of money from this stock. Now, check this out. You've got gamma squeezes and you've got short squeezes. Both are means in which you can drive price action. Now, a gamma squeeze, what is that? Basic overview, you've got call options that stack on top of each other. So coming back to the options chain on AMC, if you look at the calls, right, what do we have? This could be an endless feedback loop in which call options are purchased, end up getting closer to in the money, and then hedge funds have to hedge or purchase shares to manage their risk by the off chance that they have to exercise these options and pay back investors who have these contracts. Now, we drew this out for you pretty simply. Check this out. Let's say that you have a $14 strike right here. This is the strike price for that stock. And you've got 100,000 contracts that are going to potentially expire in the money here. And now, let's say that the prices went up to $16, but the clearinghouses haven't hedged for that. They haven't accounted for that. Well, if they have to buy at $16, but the strike price is $14, which was that you get to pay for it, they are net negative $2 per contract. And since each contract has 100 shares, that would mean that they're net negative $2 on 10 million shares, right? Which is huge. 10 million shares times 2 is $20 million that they would be negative on just that strike price alone. So they have to manage their risk. Let's say if it hits $14, if they have a strike price of $14 and all of a sudden the stock is at $13.50, well, they're probably gonna be like, you know what? I better purchase right here at $13.50 by the off chance that I need to manage these options that come in. So they're not gonna end up being net negative. They'll actually be net positive. Or even if they purchase at $14, right? That's not the end of the world. They need to manage their risk. Now, what does that mean? They're going to purchase enough collateral to match those options at that 10 million in volume, right? So that 10 million shares, that'll probably get purchased at market value. Who knows when? It can happen whenever. But 10 million shares will be purchased from market value, which drives the stock price up. This is essentially a gamma squeeze, and that's big. Now, that's not even taking into account the actual shares being purchased at market volume, because that will affect the stock price as well. If they're exercised, options end up driving the price up, because these 10 million shares, if even half of them are purchased at their strike price, that drives the stock price up. Any sort of buy transaction that takes place in the market drives stock price up. So that's huge. That's one thing that is taking place, that is hedging, and that drives gamma squeezes. And gamma squeezes can happen infinitely. They can happen for as long as there's vested interest in a stock, which is huge. And there's been continued vested interest in the stock. I mean, if we look at the 26th of March, there's already call options that are starting to roll in here. Not a ton. But nonetheless, they're starting to, and they will continue to stack up as long as there is vested interest in the company. You look at the 19th of March, I mean, look at all these freaking call options, guys. It's insane. And that has a huge potential to drive price action if we continue to run it up. 28,000, 48,000, 25,000, 9,000, 4,000, 34,000, right? You see the potential here on how this could really spiral, and it can have an endless feedback loop. So that's one piece of it. Next is a short squeeze. So what happens essentially with a short is they sell to the market right here. You've got the broker, the shorter, and the market. Broker is a clearinghouse, the shorter is hedgy, and the market is tendy. So broker spots 100 million shares, the shorter over here sends 100 million shares into the market, and he wants to buy these back at a lower price than he bought them at. So he sells high, and he buys low, right? That's the intent with shorting a stock. Now on the flip side, let's say that they purchase, or they sell, I should say, at $5, and they buy back at $20, that will shoot the stock price up. They are net negative. They lost money, and that is not a good thing for a shorter. They don't want that to happen, right? So what would happen is it would cause a short squeeze, because any sort of buying that takes place in the market drives the stock price up. And you can have an endless feedback loop with these two where they feed into each other back and forth, back and forth. Now, what do I mean by this? We're going to draw this out in simple ape language, guys. Let's say that the price of the stock is at $5, and just inherently by a sentiment of traders, it runs up to $6. Well, because it's starting to go up, you've got people then that start buying $7 strike call options. Let's just say that there are $7 strikes expiring on 19 March, and you've got, I don't know, 20,000 of these. Well, 20,000 of these $7 strikes are purchased. Now the stock price starts to run up. It runs up to, let's say, $7.20. Well, now all of a sudden you've got these clearinghouses and brokers that need to hedge for that. They need to match that collateral and say, hey, by the off chance these are exercised, I'm going to purchase the match for that 20,000 call options, which is actually 2 million total shares. 2 million total shares are purchased from that 720 value, which would then drive the stock price up, hypothetically speaking, to let's say 8. Now, let's say that you've got some shorts over here that short the stock at $5. Shorts went negative. 100 million shares at $5. They decided to cover, and this hasn't happened yet, I don't think it has, but I'll let you know, we're just going to talk about it. They cover, let's say, 20 million of that at $8. Well, that could drive the stock price up to $12, to $15, to $20. The upside here is insane. $20 right here. Boom. Crazy price action happens. Let's say that hypothetically speaking, you've got some people that take profits there, right? It drops back down to $17. Shorts reestablish short positions here because they get greedy. People are all run by two things, greed and fear. It's insane. And they go short again. Boom. Stock price drops down to $15. Shorts drop it down to $15, maybe down to $14. This could rinse and repeat again. So $14, it's undervalued. You see this sort of chain reaction happen where it's like yada, 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 boom, big spike, a little bit of a valley, drops down, does the same thing again, starts its upward trend, right? And you can see this has already kind of happened here with AMC if we look at this on a daily chart. Look at this on a daily chart, crazy spike, let's drop back, starting to wind up again. It can have another thing happen the exact same way. And that is where the infinite feedback loop comes into play with these short squeeze and gamma squeeze potential. So it runs up from 5 to 6 to 7. You've got 20,000 call options expiring in the money. And by the way, this whole time, you could have call options that continue to expire in the money. $8 strikes, $9 strikes, $10 strikes, all the way to $20 strikes. These all have to be hedged for, which would drive the stock price up higher. So this could even go to, I don't know, $25 before dropping back down to 17. And then the same thing would happen, rinse and repeat. $14 vested interest, just simple trader transaction sentiment, goes up to $15. More strike prices between $15 and $20 are purchased. They ends up going to $16. $16 strikes are in the money. They get hedged for, drives it up to 17. Hedged for, drives up to 18. Hedged for, goes up to, let's say 25. More shorts cover, drives it up to 50. This can continue on and on and on and on endlessly as long as there is vested interest in the stock. That is the endless feedback loop possibility with the short squeeze and gamma squeeze, and it's 100% possible. Why do I say that? Because there are freaking apes out there who've been diamond handing this thing for literally months, and I'm not kidding you when I say that. I have been through the freaking ringer with this, guys, and I would not be talking about this if I didn't think there was upside here. I would have just moved on. I would have just moved on and made money somewhere else because it is not worth talking about for 2 months if this is a dead cat. It's not a dead freaking cat, guys. It never was a dead cat. It won't be a dead cat. And that is what I've got for the upside here, right? It's nuts. So risk and reward, this is the last thing I want to talk about, is the risk and reward. Low ball, I think it's $20 to $25 in 4 to 6 months. High ball, it's life-changing, infinite potential, money upside, and the risk is high. There's nothing guaranteed about this, guys. It is called Wall Street bets, not Wall Street guarantees. You need to manage your risk. Please don't invest money that you can't afford to lose. And then the second thing I want to mention is options. If you're not an experienced options investor, I do recommend that you check out my YouTube video talking about options. I do have a video that talks about it in pretty good detail. You simply come over to YouTube and you type in options 101 and Trey. It will pop up. This is my video on options, and it walks you through the basic rundown of why this stuff matters, and you can play that video, and it will teach you everything that you need to know in regards to options. So, guys, that is what I have for the video. I know that was freaking long, but I want to give a basic rundown for anybody out there who does not know what's going on with AMC stock in case you are new to the channel, new to the squeeze situation, and want to get caught up. So if you enjoyed it, please drop a like. It really does help support the channel, and consider subscribing if you'd like to see more content like this. Lastly, I have an affiliate link in the description box down below for Webull. This is version 4 for the desktop. Great platform that allows you to start trading at 4 a.m. the pre-market. If you use my link, you get 2 free stocks with a $100 deposit. I'll receive a free stock. Great way to support the channel, my friends, and if you're not interested, that is totally fine. I just appreciate your support by taking the time to watch my videos. That's what I have for you guys today. Thank you for watching, my fellow friends and apes, and peace.